So on page 8 of your book, they're going to talk a little bit about things that affect supply and demand. The easy way, or the way I want you to think about this, is supply deals with the creation of real estate or the creation of the market. Let me show you what I mean. Labor force, construction, and material costs. As all of those costs go up, what do you think happens to the number of houses that get created? They go down. If it costs more to build stuff, or it costs more for me to hire somebody, I am going to build less of it. All right? That's what I'm thinking about the creation. I love the word here. It says governmental controls and monetary policy. That's a real big word, fancy word for interest rate. If the interest on the money goes up, what do you think happens to new homes being built? They go down. All right? That's why this is called things that are affecting supply. As it goes up, they work counterintuitively. As the cost goes up, the demand will go down.
That's not true for right now, though. Haven't the interest rates been on a steady increase over the past year, and so have the housing prices?
The housing prices have been, and so has the interest rate. All right? Now, the thing you have to remember is house prices are actually what they call a lagging indicator. All right? So they're talking about here is the cost to build it, the number of new production will go down. As the interest rate goes up, the number of sales do go down. All right? What we're caught in right now is something that I have always said is when you say, hey, you should buy a new home, people go, well, I'm going to wait till interest rates hit the bottom. All right? The problem with that is, how do you know when the bottom of anything is? How do you know when there's a bottom to something? When it starts going back up. That's the only way you can see a bottom, is when it goes back up. So what you're seeing right now is this knee-jerk reaction of interest rates that were down here that are now going up, and people are wanting to get in before they predict the 6 that's coming. All right? So that it's a lagging indicator. Oh, okay. Things that affect the demand. Think of usage. Usage. As the population goes up, what happens to the number of homes that get bought? As the population goes up, more homes were sold in Chicago, Illinois last year than Mohawk, Indiana. You guys know where Mohawk is? My point exactly. All right, it's population 18 if everybody's home. It says, welcome to Mohawk on both sides of the same sign. All right? Yeah. So as population goes up, demand goes up. More people, more needs. Demographics, which is the study of population, which includes all kinds of other stuff, economic factors, does break out household income and ages and typically all of that stuff. Employment and wage levels. As employment rates go up and what you pay that person goes up, what happens to the amount of housing? It goes up. All right? There's a thing called the Parkinson's principle, which says your debt will rise to meet your level of income. If you don't believe me, have kids. You know? How does she know about your kids?
She's a family member. A lot of kids.
How many kids do you have, Miguel?
Take a wild guess.
I got 6.
I got you beat.
You're rare.
8.
You got 8. You got 10? Or is that a guess? Miguel and I are in the same boat. You find something you're good at, you stick with it, right? I got so many kids the other day, I called them into the kitchen. I said, hey, doing an economic downturn, I got to let one of you go. And immediately the oldest one said seniority and walked out. So I turned to the 13-year-old and went,
Sorry,
He's like, damn. He's already hired an attorney. Hostile work environment.
They don't know how good they have it. I have 4 of them. I wanted like 10, but yeah.
I've got 35, 27, 22, 19, 17, 13, and a 12-year-old grandson. So my 13 and 12-year-old play together.
My oldest is 14 and my youngest is 5 weeks.
Somebody the other day said, oh, my wife and I are trying to have kids. Like, on purpose? You need to rethink that. You know. Yes. Yeah. John knows. I also do stand-up comedy all the time. So John knows this is where I do some of it. With 8 kids, though, you're probably like me. The first one, you know, in the middle of the night, you're like, is he still breathing? And then by the time the 6th and 7th one, they're up there crying, you're like, that's a pissed-off cry. Yeah, he'll be down in a minute. Don't worry about it. Yeah, he'll be okay. So all the governmental controls and monetary policies. We talked about population demographics and wage levels. As those go up, all the usage goes up. So think about that. And I can guarantee you on your test, one of those is going to say, as so-and-so goes up, the other will go. All right? So make sure you understand which ones affect supply, which ones affect demand. And the easiest way I'm telling you to think about it is which one affects the creation of a product versus the usage. All right? There are some financial stuff you need to understand. The first one being properties appreciate. Real estate's one of the only things in the world that's always worth more in the future. All right? However, the appreciation has to outgun the inflation because there's a rise in the cost of money as well. And we'll talk all about appreciation and inflation in another chapter. Equity. Equity represents the amount of loan that is already paid off. It's the difference between the value of the home and the outstanding loan. All right? So I always draw that. Here's the value up here, and the loan amount is down here. The difference between what you owe and what the house is worth is called equity. Right? Can I have a loan higher than the value of a home? There's a technical term for this. When your loan amount is higher than your value, the technical term for that is called screwed.
Or upside down.
It's called negative equity. Negative equity, or upside down. We laugh about it in cars, don't we? You buy a car, drive it off the lot. Oh, this car's worth half of what it used to be. Houses can do that, especially in the markets like 08, 09, 2010. Houses lost value. A lot of those people got 100% loans. The value dropped. Now they're upside down.
Or you short sailed and screwed yourself for 7 years.
But you're not bitter at all, are you? We'll talk about short sales coming up. So equity just represents the amount of money that is above the loan amount, okay? There's all kinds of tax considerations that you will deal with. Tax considerations. I want to talk a little bit about the owner-occupied property. There's a new rule that came out in 2009 that people seem to forget about, but we'll talk about it. When you buy your house, it is called a basis. When you sell your house, that's called sales price. The difference between those is your capital gains. So I bought a house for 100. I sold it for 200. I made $100,000. The IRS says if you are single, your first $250,000 of capital gains is tax-free. If you're married, it's the first $500,000 of capital gains. Only time in your life your spouse is worth $250,000 to you. At least alive. All right? So what I'm saying is, in this scenario, I made $100,000, I would pay no taxes on that money. Yeah. Now, if I made $600,000 on my house, I bought a house in Broad Ripple 30 years ago and sell it, made $600,000. I am married. Let me see what time it is. Yeah. Just checking. The first $500,000 is free. I would only pay tax on $100,000. So it's only pay tax on the amount that's over the trigger level. And it's $250 for single, $500 for married. But there's one more part to this you need to know. You also must live there 2 out of 5 years. Oh, oh, there goes that down the drain. That 2 out of 5 years does not need to be consecutive either. You can live there 1 year, rent it out for 3 years, move back in for 1 year, and then when you sell it, claim it as owner-occupied. If you live there 2 in a row, that would be 2 out of the last 5, wouldn't it? Then you sell the house and move to the next one. And I know buddies of mine that do that. They buy a house, live in it for 2 years while they're rehabbing it, sell it, keep all the money, buy them another house, and they just keep trading up. You can do that as many times as you want now.
So with loans that require owner-occupied status, that's the same thing like FHA?
FHA requires owner-occupied status, a whole different reason why, but they still require status.
But does the same rule apply? You can, however many years you own the property, you just have to have it for like, you have to live there for like 3 of those, or is that the first 3?
No, it's 3, it's 2. FHA, you can never not live there. All right, this is an IRS rule. It's a different thing. All right, you're going to find, that's a good point. Let me bring up something. Everything has different rules, and we're going to deal with sales price. We're going to deal with appraised value. We're going to deal with loan amount. We're going to deal with assessed value. Just remember which one we're talking about. This is an IRS rule. The IRS says you live there 2 out of 5 years, it's considered owner-occupied. You can be gone for 3 years. FHA lender says you can't do that. All right? But what I'm saying, the point is, if you live there 2 years in a row, the first 2 years you move in, boom, boom, that's obviously 2 out of the last 5. You now sell it and keep the capital gains. You use that, move to a next house, buy a bigger house, rehab it, fix it up, do whatever you want to do, live there 2 years, boom, sell it again, move on. All right? So you got to live there 2 out of 5 years. Any questions about either one of those? You are allowed to also take money out of your, 401k? Your IRA. You can take up to 10 grand out of your IRA to use as a down payment. You still have to claim that as income, but you don't pay a penalty on it. This is a good thing to remember for your client, all right? But they got to do it like in 4 months. They got to spend that money. They can't take it out and go, oh, we're buying for a house, and then forget to buy a house and use it to go on a world tour. Can't do that. Yes?
On that $250K or $500, is that per year?
No, it's the total price of your house profit. It's not.
It doesn't matter if it's 5 years or 2 years, it's just whenever it happens.
It's whenever it happens, but you got to live there at least 2 years. All right? And that's why I said they go by the two differences, what they call your basis and your sales price. That's all that matters. What did you pay to get in the house versus what you sold it for?
Will they tax you on the whole amount then if you haven't lived there for the 2 years?
I'm sorry, say that again.
Will they tax you on the whole amount if you don't live there for the 2 years?
Yes. If you live there like 3 months and you make 200 grand, It's now considered an investment property. You pay capital gains on every dollar of profit. And we can get into, there's a bunch of other stuff that you can do with an exchange and yada, 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 and all that. But yes, that 2 years is what you want to shoot for. Now, the IRS has these things called safe havens, like special situations, like if your husband was in the military or your wife's in the military. I don't want to get sexist here. And they get transferred a year and 6 months into it. You can apply, hey, this is a hardship case. That would have been our home, but the Army moved us. You could probably get that 2 year if you were moved. You can't just decide to sell it and be good.